Hello folks, thank you so much today for watching on the Financial Education channel. I am Jeremy, and today the video I'm doing is about what is a stock split. Now, I have this book on my table from a video I did earlier called The Intelligent Investor and why that's the best book you should read. But anyways, what is a stock split? A stock split is when a stock gets split in half, so it goes from one share into two shares. And most companies do 2-for-1 splits, and it's when their stock price gets really high. So say a stock gets to like $100 a share, a lot of companies will go ahead and split that share. So the stock price will go from 100 to 50 basically overnight, but it doesn't really matter for you because now instead of having one share of that stock, you have two shares of the stock. So two shares at $50 a piece is still worth $100 if you just had one share. Some companies will do even a bigger stock split than that. So say the stock was $100 and they did a 3-to-1 split. What would that mean then? You're going to now have 3 shares. 3 shares is what you'll have, and they will be worth $33.33 a piece because that adds up to $100. A 4-to-1 split. If a company says they're going to do a 4-to-1 split, what does that mean for you if that stock was $100 yesterday and tomorrow it's doing a 4-to-1 split? $25. 25 plus 25 plus 25 plus 25 equals 100. So now you'll have 4 shares. They're each worth $25. So the amount of money does not change, just the amount of shares do change. And the same can be said for doing a reverse split. Sometimes if a company's stock price gets too low, they'll actually do a reverse split. So let's say a company stock drops down to $1 a share. They might want to do a 1-to-10 split. So what that means is if you had 10 shares before, now you're only going to have 1 share, but that 1 share is going to be worth $10 because before you had 10 shares at $1 a piece, that's $10. But if they do a 1-to-10 split, then that $1 goes into $10 of share price, and you have only 1 share now versus having 10 shares before. So they can split it either way depending on the circumstance the company is in. Why do companies do this? Companies do this because they believe for some reason, and it might be true, that if a stock price gets too high, it will scare away a lot of retail investors that invest small amounts of money. So they'll miss out on that opportunity. I don't know if that's true or not because you look at a stock price like Google, it's like $700 a share, $600 or $700 a share, and Amazon's in the 400 or 500s, and it really hasn't hurt those companies. Apple, for a long time, they were in the $600 or $700 a share, and when they were $700 a share, they did a 7-for-1 split, so the stock price dropped all the way down to $100 after that, but all those investors got 7 shares. So, and the same thing can be said if a stock price is too low. Companies might think, no investor is going to want to invest in us because they're going to think it's a scary stock because the stock price is so low, so let's do a reverse split and get that stock price up, but just depress the amount of shares outstanding. I hope this explained very simply what a stock split is. I thank you guys for watching. Please subscribe if you have not, and have a great day.